Buenas tardes a todos, bienvenidos. Vamos a dar unas indicaciones antes de comenzar el seminario. Si ven en la parte de abajo de sus pantallas, algunos van a tener la insignia de un globo, de un mundo o tres puntitos. Si aplican, si apachan ahí, entonces van a poder, si desean oír la presentación en inglés o en español, ¿sí? Para poder escuchar la presentación de Jessica, ¿sí? Entonces, cualquier duda, cualquier pregunta, por favor, nos las hacen saber, ¿de acuerdo? Bueno, bienvenidos. El día de hoy, pues vamos a tener a Jessica Spacer. Ella es nuestra gerente de comercial. Hoy nos trae una plática sobre tendencias del mercado de las carnes rojas de los Estados Unidos y que pues esperamos que sea de provecho para todos ustedes y pues le damos la bienvenida a Jessica.
Thank you so much. It's great to be with you all this afternoon. So I'm going to get my slides going here so we can get right into it. Okay. There we go. So today we'll be speaking about the US beef and pork markets, and we have a lot to cover. The themes for pork are really similar to what we talked about earlier this year, if any of you were on the April webinar. But the beef situation has changed a little bit, so our longer term outlook remains the same. But right now, we've actually seen higher supplies than were previously expected for beef production. So today we're going to start with the beef situation and we'll talk through why that's happening. And then we'll talk more about the US pork situation. So on the beef side, just to start with a summary, last year in 2023 was the first year that US beef production decreased since 2015. And that is because of where we're at in our cattle cycle, which I'll talk about more in a moment. So once production decreased last year, we were expecting production to decrease again this year. And actually, because steer carcass weights and heifer carcass weights have been so high, we've actually seen slightly higher beef production, especially in recent weeks. So now it looks like beef production will be about steady with last year in 2024. But we do expect to see more significant drops again in 2025 and through 2026. But where we're at right now, it looks like we could start to see production increase again in 2027. So even though, we are on that production downtrend, we have some positive factors that are helping drive the thought that we will see herd rebuilding gain momentum in 2025. So one of those would be a noticeable improvement in the drought situation. And also we have much lower feed costs now. And that has helped balance the more limited supply of cattle that we have. So with the cheaper feed costs and the incentive to add more pounds per animal, we've seen just record steer and heifer carcass weights, which we'll talk about a little bit more too. And those record weights, more days on feedlots, are leading to very strong choice and prime grading percentages. So prime production, US prime beef production is actually up over 17% from last year, and it will be record large. And choice beef production is up slightly from last year as well. So we will see, we'll talk through this more, but we do see, especially in recent weeks, higher fed beef production. So from our cattle coming out of the feedlots, which is by far the majority, over 83% of US production and most of our exportable supplies, that has been offsetting the decrease in the lower non-fed beef production, which comes from our cows that are sent to slaughter. So here's a closer look at kind of what we mean by where we're talking about where we are in the cattle cycle. So on this chart, you can see the blue bars are showing production, annual beef production in the US, and this includes USDA's forecasts for this year and for next year. And we're overlaying that with where the beef cow inventory is at the start of the same year. So once we see that the beef cow number reaches the lowest point for that phase of the cattle cycle. So after we've seen liquidation of beef cows and right before it turns around, with producers holding back more heifers on ranches to have calves and to increase the beef supply, we see that it takes 2 years from that bottom point for the number of beef cows before we can see larger beef production again. And that's just because of the long production time that it takes for an animal, a producer to decide that they're going to have a female animal have a calf, for that female to have the calf, and then the calf to transition into the beef supply, first going through the feedlot process and then becoming beef in the supply chain. So we expect to see that bottom number for this cattle cycle for beef cows on January 1, 2025. So with that is why we're still expecting to see that larger production again in 2027. But where we are now, which we'll talk through more, this does mean that we are going to have lower beef production in 2025 and 2026, because whenever producers are rebuilding the herd, that pulls back production more sharply, because more animals are being held on the ranch to have calves rather than being sent to slaughter. So USDA's latest forecast, oh, and it looks like here, maybe I didn't update my bar for 2024. I'm sorry about that, but the text box is correct that 2024 production should be up just 1% from last year. So this is their revised forecast that they released actually last Friday. This is from USDA last Friday. So earlier this year, every report from USDA was expecting lower beef production, and they've been raising their production forecast each month because of this higher production due to these really heavy cattle weights on feedlots. So we now see that production is expected to be about steady with last year, when production dropped close to 5% last year. And then again, we expect tighter supplies again starting in 2025 with a more significant drop, whereas this year we're holding close to steady. And so here's a summary of how that kind of breaks out. So trying to separate out the major factors here that I was talking about. So year to date, our total beef production is down 0.9% from last year. But as we can see, the higher fed beef production, so our production from steers and heifers from feedlots, is up 1.5% from last year. So that includes our choice, prime, and select production. This is the majority of what we're exporting and the majority of supplies in the US. So that increase has almost totally offset the very big decrease that we have in our non-fed beef production, which would be that beef production coming from cows that are sent to slaughter. So our non-fed beef production is down basically 13% from last year. And that is because after years of liquidation, so sending more cows to slaughter because producers were not building up the herd, we had lower overall cow numbers in the US as more were sent to slaughter. And so now we're just at that point where there's more limited cows available even to send to slaughter or hold back. So we have lower overall cow inventories. And so we're seeing that sharp decrease in non-fed beef production, even though through mid this year, we were not seeing any herd rebuilding yet. So we're at the stage right now where herd rebuilding should start to gain acceleration this fall and into early next year. And so with this big decrease in cow slaughter, which I'll talk about a little bit more when we get to the price side, but I just want to note that because of that, there's been a lot of pressure with the lack of lean beef supplies. And so that's really been supporting prices for lean beef trim, but also for the leaner beef items like rounds and chucks that we see on the choice side as well. So there's this need for lean beef in the US complex that's really driving up prices for those lean items. So now I want to talk through starting on and look a little closer at what's going on with fed beef production. So again, looking at the picture coming from our steer and heifer slaughter, you can see that slaughter was mostly below year-ago levels through most of the first half of the year. But in recent weeks, slaughter has been closer to what we saw last year at this time of year. And steer and heifer slaughter is actually only down 1% from last year. And most of that decrease is coming from heifers. So steer slaughter is down just 0.1% from last year. So steer slaughter has held very close to steady because we still had pretty ample supplies of cattle on feed, which I'll talk about a little bit further here in a few slides. But steer and heifer slaughter combined is down only 1% from last year. And that has been more than fully offset by this strong increase that we've seen to record heavy cattle weights. So this chart is showing you steer carcass weights, and these are at all-time record highs now, and weights continue to move seasonally higher in the fall. So where we're at right now in October, we continue to usually see that typical seasonal trend higher for weights. And so far this year, steer carcass weights have averaged up 2.6% from last year. So we have a couple factors going on here. One of them are longer days on feedlots that are helping contribute to the heavier weights. Also, the incentive to feed longer and to add more pounds from cheaper corn. So corn prices are down roughly 30% from where they were 2 years ago. And we've had very abundant production of corn and very abundant stocks of corn in the US, both last year and then this coming harvest. That's expected to continue. So large supplies and lower prices for corn. And with where cattle prices have been at record highs for parts of this year, that is encouraging, feedlots to continue to add weight, to add pounds to the animal before they sell them to the plants, because they're paid on a per weight basis. And we do expect this trend of these heavier steer and heifer carcass weights to continue into next year. And that's going to help minimize the decrease that we see in fed beef production next year. We will see a decrease in fed beef production next year, but that is going to be somewhat offset by continued heavier carcass weights. And so with that heavier carcass weights, we also see strong grading percentages for our high quality beef in the US. So that would be for our prime and our choice beef production. So here you can see what prime and choice beef production breaks out as in pounds on the bar chart, whereas the chart or the table where I have the percentages is showing the percent of fed beef production that graded within each of those quality grades. So we have very strong prime grading percentage. Choice is not at a record this year, but it's continuing to hold at a very high level. And so with that, we see prime beef production is actually up 17.5% from last year's pace. Year to date, it is down only from the 2021 record. But through the end of this year, it should surpass that and set a new all-time record for prime beef production. So even though, we've come down from where we've been at our record total beef production in 2021 and 2022, we are managing to still see more abundant production of our highest quality beef, so of our prime grading percent. And choice beef production is also up 1.5% from last year. So that's leading to combined increase of 3% from last year for our combined choice and prime production. And I'll look at it a little bit more closely, but the choice production increases have largely come over the last couple of months. So we've seen more of a notable increase pickup in that choice beef production in recent weeks. So here's a look again at the change. So this is still talking just about fed beef production. And this is showing the change year over year in fed beef production by week. So as you can see on the chart, the dark blue line was for 2023. So for essentially most of the year, fed beef production was lower than 2022 for nearly every week last year. And then when we started out in 2024, fed beef production continued to kind of drop from those lower levels during the first few months of the year in January, February, and March. But since April, we've seen this trend where we've seen essentially higher fed beef production nearly every week compared to last year. And this data is through mid-September because the data from USDA is lagged a couple weeks for the official production data. But we did continue to see strong production levels until last week. And so last week we did have lower steer and heifer slaughter for the week ending October 11th. And that did pull back on some of those supplies for last week. So we saw a surge in some spot prices last week, especially on some of the chuck items, which we'll talk about a little bit later. But again, after falling, over 4% last year, we will see higher fed beef production this year, but we're expecting to see a decrease again in 2025. And now this is the kind of the same idea here. So now we're just looking at this year. So just for 2024, we're looking at the weekly comparison for this year compared to last year for the change in choice production and in prime production for each week. So looking at it, you can see the dark blue bar is for prime beef. So prime beef production has been higher nearly every week so far this year, and that's as we've seen a higher percentage of total fed beef production grading prime. Whereas choice beef production was really lower for the first few months of the year and has been higher since April. But really, you can see where I circled the green circle on the chart. We've seen consistently very strong increases in choice beef production compared to last year since late July. So that's really when that increase started to accelerate. And if we're looking at just the last 6 weeks of production compared to last year, choice production was up almost 7% from last year, and prime production was up almost 22% from last year, or over 22% from last year. So that was for the 6 weeks ending in mid-September. So again, we had talked about tighter supplies because supplies are still lower from where we were at our 2021 and 2022 records, and demand remains strong. So it's not like we have this abundance of supply because domestic demand has remained really strong in the US despite record high prices. But we do see more supplies available in recent months than were originally expected for this year. And that is because of the situation of what was going on with the cattle on feedlots. So these charts here are showing the total inventory of cattle on feed and also the placements of cattle on feed. So when cattle are put into feedlots, the number of placements each month of steer and heifers being entered into feedlots. So as you can see, our inventory of cattle on feed has been mostly higher through this whole year. And that's a little bit maybe different from what a few of the points I made at the beginning, because overall our cattle inventory numbers are down. So at the beginning of this year, our January data for 2024 showed lower cattle numbers across all of the categories compared to last year. So the reason that we've had higher cattle on feed supplies through the latest data of September of this year is because we had very large placements in late 2023, and those ended up getting kind of spread out through the year. So we had very large placements as producers were liquidating cattle in late 2023, and then marketing. So when the cattle were contracted by the plant to go to slaughter, so when the cattle are moving out of the feedlots to be slaughtered, were much slower earlier earlier in this year than the usual pace. And part of that had to do with profitability because of the record high cattle prices. So that being a challenge for some of the plants at the prices that they were getting for wholesale beef at that time. So there was a slower slaughter pace early in the year, and that led to larger supply kind of holding over from month over month and keeping this total number of cattle on feed elevated. So since that has happened over the last 9 months, we've seen a drop in placements, and that is expected to continue because we just don't have the cattle available outside of feedlots to keep placing more and more numbers on feed. So what that means here, you can see pretty clearly on this chart. So this chart is showing the cattle inventory of cattle that have been on feedlots for over 120 days. And then the chart below that is cattle that have been on feedlots for over 150 days. So this is the way we would measure cattle that are ready for slaughter. So our supply of cattle that are ready to be slaughtered. And so you can see when the marketings were slower earlier in the year, we saw this jump in those supplies in April and May. And so we've been working through those larger supplies as the slaughter pace picked up again. And as of the latest data of September, the cattle on feed inventory over 120 days was steady with last year. and over 150 days was up 4.5% from last year. So that is still indicating, that increase of 4.5% compared to last year means that we're still going to have expected larger production of this fed beef production through the end of this year and into early 2025. But we are working through those supplies and kind of bringing those closer to where we've been. So while the increase was 4.5% in September, it had been plus 10%, plus 12% in previous months. So we do still have a fairly abundant supply of cattle that are ready for slaughter, that are helping support those higher fed beef production levels. But we are working through that, and that is going to tighten into 2025. And so this is just another way to talk about that. This data is from our January cattle inventory report from USDA, which is now only an annual report that will be released every January. And at that time, this shows the cattle that were available in the US outside of feedlots that are able to be placed on feed. So all the steers and heifers that we have that aren't being held back on farms, that haven't been put on feedlots yet, that are available to be moved on to feed this year. And as you can see, we've really been pulling down those supplies. So that's why we're finally expecting this production to turn in 2025, because we just don't have the cattle on the ground right now to be able to keep increasing these cattle on feed inventories. So we need to have this turn where we have more beef cows held on ranches to have calves before we're going to see those larger supplies available to be placed on feedlots again. And so that goes into what USDA is expecting on a quarterly basis for their production forecast. So again, you can see that they expect, and this is for total beef production, so fed and non-fed beef production together here. They expect, oh, I feel like I have to sneeze, sorry. They expect that Q4 production will be higher than last year. That follows increases for both the second quarter and third quarter of this year, driven by that higher fed beef production. But you can see that when we get into 2025, they start to expect those lower supplies really noticeably in the second half of next year, because that's when we're expect to have really pulled down our cattle on feed inventories. Because with where the cattle on feed numbers are now, that should continue to support fed beef production through early 2025. So then once we get past that is when we're going to start seeing these more significant decreases in beef production. And now onto the steer price side. So again, this is now showing live steer prices. The black bar was for this year, and then the orange squares are where futures are currently trading for next year, for 2025. We were at record levels earlier this year in June and in July for steer prices. The futures market right now, it has prices a little lower than the record highs that we've seen in 2023 and 2024, but analysts are expecting steer prices to average a record high again next year and to continue to reach records as we have these lower and tighter cattle supplies. But again, this is just showing a snapshot of where the futures markets are trading now, and that reflects some of the overall downtrends that we've seen for all commodities. So on the balance of having the tighter supplies, analysts are expecting to see cattle prices actually holding at the record levels or increasing next year. And now I'm going to show a little bit on the beef wholesale price side. So this is showing our choice beef cutout, which is a measure of our average wholesale beef prices and how those break down for boxed beef. And so the green squares are last year and the blue circles are for this year. And so you can see that, for most of this year, earlier in the year, we were holding well above last year's record highs. But since the summer, we've been trending pretty similar to year ago levels. I did these slides before the data was released for last week. So the October 11, the week ending October 11 data is not included here. And last week, the cutout actually jumped up to $3.08 per pound because of lower slaughter last week. So we did see a jump last week in the cutout, but Again, here we've been tracking pretty similar to these, record high levels that we saw last year. The choice cutout will average a record high this year, expected to average another slight increase next year to on average set a new record high. And so this is taking a look of how that breaks down by primal now. And again, what I want to really emphasize here is what I mentioned a little bit earlier, that we're really seeing support on the lean side. So the biggest increases for choice beef prices have been in the chuck and the round primal this year compared to last year, whereas the loin and the rib primals are down slightly from last year's record. So we have seen some of our really popular highest price point steak cuts like tenderloins and ribeyes are below the record highs set last year, as we've seen consumers looking for value options. We continue to see really strong beef sales and demand in the US, but there has been some of that downshift. So we'll talk about that a little bit more in a minute. So loins and ribs are a little bit just slightly lower than last year's record high. So we haven't seen big jumps in that on the domestic side. Where we're seeing this drive higher has really been more noticeable in the chuck and the round compared to last year, and for briskets as well. So now on the next couple slides, I have some wholesale choice beef prices here. These are just for reference, so you can see the seasonal trends. These are only reflective of the domestic spot market. They're FOB plant prices that are required to be reported to USDA. And again, these only include domestic, so they're not reflective of the factors that would be included in export quotes. But just to see here are some of the trends that we're talking about and the domestic drivers. So here I have some of your steak cuts all together on the same slide. So choice ribeyes and tenderloins at the top, New York strips, and top sirloin butts on the bottom. So again, as I mentioned, you can see that compared to last year, ribeyes and tenderloins are not at the record highs that we saw. They continue to hold at historically high levels, and we continue to see strong prices, but we are below the record highs that we saw last year. Whereas New York strips and top sirloin butts both surpassed the 2023 highs earlier this year. So again, that's signifying this drive for value. We're seeing some of that shift towards alternative items and more value options for consumers, and so driving up those prices for some of the more value price point steak cuts. And here I have some of the chuck prices included alongside outside skirts. I want to note the chuck roll here, which again, this data is through October 4, and last week, excuse me, we saw another big jump for chuck roll prices. So chuck roll prices typically reach their peak for the year in October and November, as you can see on the chart, and we have been on this strong uptrend through September, and again, kind of mirroring some of our typical seasonal increase, but it's happening earlier than usual and is stronger than usual, with prices now at all-time records, except for a couple weeks in 2020 after the first COVID disruptions. So we are continuing to see strong demand. This is a popular domestic and popular export cut to both Asia and Latin America. And we've seen more limited inventories available in the US, and that's helping drive those prices higher as we move into a high point for seasonal demand. Shoulder clod prices have also been holding mostly above year-ago levels, but we've seen some of that seasonal easing since our highest seasonal point earlier in the year in the first week of July. So we've seen some of that easing, and similar on the outside skirt, where we've seen that following the typical price trend. Petite tenders also following more of our typical 5-year seasonal price trend since the middle of this year, after we saw the strong uptrend last year. And then on rounds here, I have briskets on this as well. But again, round prices have been supported by this need for lean beef. So especially earlier this year, we saw ground beef processors looking for more rounds to use in their ground beef formulations, because domestic lean beef 90% lean beef where prices were at record highs, which I'll show in a minute. And we also see higher prices for imported beef, imported 90% trim. The US has been just importing huge volumes of Australian lean trim because we have lower cow slaughter and we need that lean trim in order to make burgers in our ground beef, which is still it's over 50% of US production or US consumption of beef is in the form of ground beef. So we need that to help balance our domestic supplies so we can make ground beef. And with that, we saw price support, especially on the round and the knuckle, as you can see, since the knuckle can be used for ground sirloin. So price support there on strong demand for ground beef in the US. And then we saw a bit of a correction in recent weeks, but last week prices turned higher as we are moving towards our seasonal time for featuring of these round roasts. So that becomes more popular with the colder weather that's setting in now and into next month. And brisket prices as well have been holding strong. And so you can see even the counter seasonal kind of the strength and the increase in the last week of data as we've been holding those mostly above year ago levels in 2024. So my last slide here on prices is just trim. So showing the difference here between 50% trim, so coming from our fed cattle trim, and then our domestic 90% lean trim. So with the lower cow slaughter that we talked about earlier, that has led to more limited supplies of 90% trim and record high prices. So prices have come down seasonally somewhat. So we see lower ground beef demand after back to school season in September. So we see this seasonal decrease, but prices are still holding close to those record highs that they set back in July and August. And, once we do start to rebuild the herd, we're going to pull back cow slaughter even further. So, this is not something that we expect to see changing in the short term. There's going to continue to be that pressure of more limited lean beef supplies domestically. And on the 50% beef trim prices, so prices had been lower than last year. Some of that, again, was because we had that rebound in fed beef production starting in April. And so we had more supplies, especially than a lot of participants in the market had expected earlier in the year. So we had more available supplies of 50% beef trim. And they did get a run up in the late summer ahead of some of our peak ground beef demand. And then the typical trend down now after back to school and into the fall. So seeing that correction there. But again, you can really contrast the difference in prices. In 2023, we had our big decrease in fed beef production, whereas in 2024, we're seeing that really strong support on the lean beef side with that pullback in non-fed beef production. And, so as we look ahead, our per capita supply availability in the US of beef actually should be higher than last year. So that is because if production holds close to steady, we have larger imports and lower exports. So that leads to a higher supply availability compared to last year. But remember that we're doing this at record wholesale prices. So even with essentially higher supply availability, we're seeing record prices on very strong demand. And we just want to consider that as we look ahead to next year, where we will have a pullback in per capita supply availability. And we are expecting to see larger or higher, slightly higher, or modestly higher, I should say, wholesale beef prices on average as we see those more limited supplies next year. And so lastly here, before we get into just a little bit on the export side, I wanted to show the retail prices in the US. So retail prices have been at record highs for beef, but beef retail demand has remained strong. There is some shifting, as I said, of some items, but overall sales of fresh beef are higher than last year. Sales of ground beef have been strong as well. And I have the data from just the beginning of this year to mid-July. Retail sales were up 0.4% for fresh beef. But if we look at the last 52 weeks ending in September, beef sales were up 2.6%. So, we've seen strong beef demand even at these record high prices. We're seeing strong demand of beef at food service as well. The only exception was some slower quick service traffic because consumers were unhappy with the value they were getting for really high prices at fast food. So that was some pullback that was impacting the 50% beef trim prices that I showed. But overall, strong demand in the US. And, we continue to see consumer satisfaction of buying beef. So beef draws people into the stores. Retailers that feature US beef see consumers that are spending more money in their basket when they're also buying beef. And NCBA has some data on consumer surveys of their beef eating experience, and 90% of consumers are reporting a positive eating experience, whether they eat beef from the grocery store or from a restaurant. So we continue to see people coming back again and again to purchase beef, even at these record high prices, because we've seen that big improvement with this very consistent high quality beef supply that I showed earlier with our choice and prime production. So that has, really won over consumers, and it's a very important part of the American diet. So we continue to see that strong beef demand domestically. And on exports, so we've seen exports pull back. The notable pullback was in 2023 when we had that drop in production. So we saw a huge ramp up in exports in both 2021 and 2022, and then the pullback last year. But this year, we have seen a slight decrease in exports. However, exports are going at a higher value than last year. So volume is down slightly, down 3%, but value is up 4%. And that continues to indicate the strong demand situation that we have. So we're seeing those higher prices. And you'll notice on the chart that Central America stands out here, along with Mexico, the Caribbean and Dominican Republic, and the Middle East is the other market where we're seeing a rebound in beef exports. So we're seeing strong growth in Mexico, Central America, Caribbean, and Dominican Republic, and then a rebound in the Middle East back towards the strong volumes 2 years ago. And here's how that looks when we look just at Central America. So Central America through August, US exports of beef to Central America were nearly back at the 2022 record pace. So volume was down just 0.6% from where we were in 2022. And for the Dominican Republic now separately, we've seen the volume up 7%, also on a record pace. So continued growth here, following growth in 2022 and 2023. And with that, my last slide on beef, here are my export forecasts for this year. And you can see again, for Dominican Republic, I expect that record pace. We are expected to see record volumes this year. And also for Guatemala. So Guatemala has been the big driver there with records in recent years. Volume is up again through August, again on a record pace. So I have that expected to end the year up 4% from last year's record. And then the other growth market has been Panama. So we've seen very strong growth in volume so far this year to Panama, and I expect that to end the year a little bit higher than the 2021 previous record. While in the rest of the markets, we've seen a decrease this year. So you can see my forecast on there is we've seen a pullback in beef exports to the other markets in the region. Okay, moving on to pork. So pork, here's just a summary of a few of the, the different sides of the market that we're going to talk about. So we'll start with talking about the production and supply side situation. Production is higher this year, and it is expected to set a new record next year. So with the latest USDA data that we have that I will talk about, it looks pretty realistic that we could see modest growth in 2025. And so the latest information does continue to support to see this modest growth in the US, and USDA is forecasting record production in 2025. On the demand side, we saw an improvement in fresh meat demand in the US, especially like early in this year compared to the first half of last year. So that supported prices compared to the first half of last year for some of our retail pork cuts. And we followed the usual seasonal trend of a lot of those items increasing in May and June for our summer seasonal peak with our grilling holidays. Since then, we've seen prices adjust lower seasonally, And right now we're in October, which is the pork month in the US. So there's more retail featuring of pork in October. But we're also moving to our largest production time of the year. Production increases, close to 9% typically from the third quarter of the year to the fourth quarter. So we see larger production. And then for the month of November, some of that slowdown in seasonal demand for some of those fresh pork items. And we've really continued to see opportunities on the export side. The US is exporting a record percent of production. We continue to see competitiveness across the world compared to the EU, especially in some of the Asian markets, especially earlier this year. And we also, typically the US is exporting a large share of our production of hams and picnics, but we've seen a big increase in the percentage of our loin production that we're exporting. There's also more opportunities on items like bellies and tenderloins and ribs, so we continue to see opportunities here. So to start with the producer situation, so like producers in essentially everywhere in the world for the most part, US hog producers lost money in 2023. So you can see on this chart showing profitability versus loss with the black or the red bars that 2023, those were significant losses that continued through early 2024. And that happened because of the very high input costs. And that was the major driver there. So hog prices did pull back a bit, but the big factor was that input costs were at record high, essentially across the board. Feed costs had come down, but everything else remains, at a record high or near record high. So this year, we have seen some improvement with profitability in recent months, as we've seen the seasonal increase in hog prices. However, you'll notice that profitability has been modest compared to where you see the increases in the black bars on the chart for other years. And so on a whole, producers are not expected to be profitable this year for the average producer. So with that, we have seen producers balancing the sow herd to kind of bring supplies back in line to where we need them, because we continue to see strong growth in production driven by increasing productivity. So we have seen increasing number of pigs saved per litter, which I'll talk about. And also now in recent weeks, we're seeing increasing carcass weights again. So that's leading to higher production. And despite cutting the sow herd. So on prices, again, you can see hog prices to the right there. So they did adjust lower this year, but again, the big factor has been those near record costs for producers. And so in mid-September, hog prices were down just 3% from last year. And you can see on the pink bars, we're expecting hog prices to trend fairly similar in 2025. And so here's what I was talking about on the breeding herd. The green bars here are showing our sow inventory in the US. And this is from the latest quarterly hogs and pigs report that USDA released at the end of September. So again, we can see producers have been cutting the number of sows in the US in recent years. And that makes sense because we're trying to rebalance supply with the amount of sows that we actually need, because we've had this surge in productivity. So you can see on this chart, this is the number of pigs saved per litter. And for the most recent quarter, we finally saw growth return kind of more to a normal trend line. So the growth really slowed during COVID. And that a part of that was because of the lack of labor available on farms, and because initially in 2020, we didn't want a huge ramp up in production when there was less labor available at plants as well. So we were slowing that productivity growth. And then as we came out of the pandemic, the labor situation improved. We saw these strong increases, over 4% for subsequent quarters, in this surge in increase in the number of pigs saved per litter. And so that's finally kind of brought us back to the growth trend where we were before COVID, where we now expect to see closer to 1%, around 1% growth compared to the previous year each quarter. So we've seen that return to more normal. But up to this point, so earlier this year, that huge growth was offsetting any decreases to the sow herd. So even though we had lower sows, we were having these larger pig crops because of this increase in the number of pigs, say, per litter. And so now that we finally had that trend line growth kind of level back out, the pig crop for June to August was down 0.8% from last year. But with the number of market hogs that we had, so market hogs would give us the idea of where we can expect hog slaughter to be in the US over the next 6 months. That number on September 1 was up slightly from last year, so up 0.7% from last year. So we know those are the latest numbers from USDA on the hogs in the pipeline. And with that, USDA is forecasting this growth of 2.4% this year. That's based on a strong Q4 production increase. And then in 2025, USDA's forecast, latest forecast is for 2% growth, which would be a new record, surpassing that 2020 record. So again, we are seeing that the sow inventory now kind of is balanced out at this lower level. We've seen that return to more normal trend growth in pigs say per litter. So this growth can come more from where we're seeing the expected increase in carcass weights is playing a part here as well, which I'll show in a future chart. So now this is just showing where we are year to date on our pork production. So year to date pork production is up 1.6%. Again, you'll remember USDA's forecast is for 2.4% growth for this year. So that's expecting a big Q4. One of the reasons is because there's an additional slaughter day this year compared to last year in Q4. But even when accounting for that extra slaughter day, we do expect to see strong growth in production in Q4. And so higher production here. And one of the factors there has been a return to heavier carcass weights. So carcass weights had been below year-ago levels earlier this year. And then since about May, we've seen them continue to outpace last year's level and be higher year over year. The more inexpensive corn, so the more affordable feed prices are a factor here. And again, we have abundant supplies of corn in the US and expected at this harvest. So that will continue to support this expectation for heavier carcass weights. On the soybean side, you know, we've also seen soybean meal prices come down. Soybean production is expected to be up like 10% from last year in the latest forecast. So the US is expecting record yields for both corn and soybeans this coming marketing year. So again, we do have that outlook for continued abundant feed and more affordable feed prices that will support heavier carcass weights and thus support this idea that we do expect to see continued modest increases in production in 2025. So now onto the wholesale price side. So again, like on the beef side, these are just included for reference. These are going to be on the price cut charts I show. These are the FOB plant prices. So for pork, they include NAFTA, so it's Mexico, Canada, and US here. But these are spot market prices, not reflective of export quotes, but meant to show our trends and our seasonality here. So on the pork cutout, you can see the dark blue triangles are 2023. So you'll notice that really through the first half of this year, we saw prices strongly above last year. And that was, as I talked about, because of that improvement for some of the fresh pork items and also for bellies was one of the big ones compared to last year. And then since then, you know, we saw the typical seasonal trends. But the price peak in July was lower than usual. It was a more modest price increase. That's really driven almost entirely by bellies, which I will show. And then we've had this seasonal adjustment lower for hams and belly prices kind of driving these seasonal trends in the cutout. So for the latest week of data, the cutout was up slightly from last year, but remains below 2022 levels. And this is how that breaks out on a primal basis for the year-to-date data. So again, that increase has been on ribs. So that was one of the major factors with the stronger demand at retail earlier in the year compared to last year. So ribs, one of the drivers there. as well as bellies. So bellies have been have been a big contributor, but prices have been lower for bellies to compare to last year for almost every week since July. So it's a little misleading when we look at it just to the year-to-date average. Loins slightly higher than last year. Hams, butts, picnics, all just averaging slightly higher than last year as well. So now to start with our ham price trends. So on the ham side, again, we've continued to see strong prices supported by our export demand to Mexico. So Mexico takes a majority of our heavy bone and ham production in the US. And the other main export markets after Mexico for this product would be Dominican Republic, Colombia, and then also Central America as well. So this is primarily an export product. In 2022, some of that higher price was driven by some of the HPAI situation. So when there were more limited turkey supplies for Thanksgiving, that was a factor there. So the 2022 prices were kind of misleading when we look at them compared to the other seasonal trends on the chart. So prices have been tracking more in line with what we saw last year. And now on the boneless ham side, so we have seen some kind of more sluggish demand for US deli items, especially earlier this year, that were pressuring some of the boneless ham prices as the labor situation has improved in the US coming out of the pandemic as well. There's also more labor available to bone out items and to bone out ham. So we have relatively larger boneless ham production than we did 2 years ago in 2022 when the labor shortages were still more extreme. So that's also reflected here. But again, you can see that we have had some of this pressure from some of the more sluggish deli demand and some more opportunities potentially on boneless hams. So now looking at bellies. So again, bellies were some of this driver where we saw the stronger prices compared to last year, essentially from January through June. Bellies have a seasonal trend where they really increase strongly in July for their high point of consumption for the year. And then we see that pull down in correction back downward in prices in August. And you can see that this year, the seasonal increase was much more modest. Some of the struggle has been because of the quick service restaurant sales struggles. So I mentioned it a bit for beef as well, but fast food restaurants are really where consumers have kind of focused on the huge increases in menu prices and value that you're getting from the fast food restaurants. So this is where we've seen more of a focus on shrinkflation, more on social media about the small items that you're getting, or like paying $20 just for a lunch at a fast food restaurant. So it makes more sense to go to a step up from that for a restaurant like a fast casual, or to go to the store and just cut it out altogether. So we saw customer traffic pull back from quick service restaurants earlier this year. And that, of course, is where we sell a lot of our bacon. So bacon has huge sales at food service. Most of the pork sold, the majority of pork sold at food service is in the form of bacon. So especially on those breakfast items, but also bacon on a lot of the quick service restaurant burgers. So that has been some of the pressure there. We had also seen pretty heavier stocks, but those have pulled down. So we don't have an abundant stock situation anymore on the belly side. And retail prices had ramped up really high and scared off a lot of consumers, but we've seen that pull back a little bit as well. So now on picnics here. So to the right, I have our SS Smoker Trim picnics. Prices typically reach their high point at the end of the year, as you can see in November and December. So we've been ramping up towards that seasonal increase. And then on, I have cushion meat on the top, and then 72% pork trim on the bottom. So, we saw strong prices, especially like in this spring. So in March and April, and that was ahead of some of our grilling season demand for making our very popular sausages, hot dogs, processed products for grilling season. And in recent weeks for both these items, we've seen prices tracking kind of similar to our typical seasonal trends. So now on the loin side, so Again, we've seen loin prices improve from last year, especially through the first half of this year, as we saw some of that improvement in that fresh pork demand compared to last year. But you'll notice it kind of varies by item. And while prices have been strong, we are moving towards our seasonal trend of our larger Q4 production, and thus some of the seasonal price pressure that we see when production really ramps up in October, November, and December. So, through the end of this year, we're going to see larger production, likely every week except for the holiday week. So again, that's where we see some of those lower seasonal prices typically for loins. And then on ribs and butts here on our last price cut chart, again, similar to what I was saying for a lot of the other items. So we saw those higher prices, especially earlier in the year compared to last year. But then we saw a much lower seasonal price peak, largely for grilling season. And since then, the seasonal correction lower, especially for butts, as we've gotten out of this grilling season demand. So prices are now below year-ago levels there for what we see on both bone-in and boneless butts. Rib prices on the spare rib side remain supported, as well as for St. Louis spare ribs. So again, that's one of our a very popular item that remains in demand. We do see prices, though, well off those 2022 highs, and those were driven by the crazy domestic demand for ribs that year because of the stimulus checks. So we have seen more of a normalization there. And so lastly here, just really briefly on pork exports. So I wanted to just include one slide on the global pork export situation. So for the top pork exporters, we are seeing growth in their total exports compared to last year, but that's split. So the drivers of the export increases have been the US, Canada, and Brazil. We continue to see this adjustment lower for the EU, although down just slightly from last year, but they really dropped significantly over the last 2 years on that slowdown and pullback from buying in China, and also as their domestic production corrected up sharply lower over those 2 years as well. And then exports are also lower out of the UK, out of Chile, and out of Mexico. So drivers here have been US, Canada, and Brazil. And the US, of course, the leading exporter, still out of those growth markets. So exports from Brazil, they've really been ramping up their exports and production and growing the share of their production that they're exporting. But their total volume is still about 40% of US total exports. So here's US exports by the top markets. Mexico continues to just drive these huge record volumes here. So we continue to see significant growth driven by Mexico. And then across the board, it's somewhat mixed by the other markets. We've seen strong rebounds in Korea and in Australia and New Zealand, into some of the ASEAN markets as well. And where we see in Latin America, along with Mexico, you can see Central America is very strong growth. South America, that growth is driven essentially all by Colombia and for this year. And then also slight growth out of the Caribbean and the Dominican Republic. So we are expecting, we're not quite on a record pace, but USMEF is forecasting that we will have record large exports by the end of this year, that we are going to catch up to our previous record pace with large Q4 export volumes. And we've also seen a higher increase in value on the pork side as well. So volume is up 4%, but pork export value is up 7%. And here's how that breakout looks for Central America. So again, you can see by far on a record pace. So this year we are going to beat that 2021 export record to Central America for US pork. And for the Dominican Republic, we are down 7% from last year's record pace. Still the second highest on record, but we've seen some of a pullback as we've seen some entry of Brazilian pork into that market. So overall, US, our total shipments to the DR from all suppliers are still are going to set a new record, but the US is pulling back somewhat as we have now a new entrant in that market from Brazil. So here's how that looks for my breakdown for the forecast. So this would be for my forecast for the 2024 annual volume. So again, I'm expecting exports to the Dominican Republic to pull back to closer to 91,000 metric tons after the record last year, closer to 100,000 metric tons. Still the second highest on record and holding at very high levels compared to pre-ASF in the Dominican Republic. And then also I'm expecting, as you can see, essentially records across all the other markets in the region. So volume to Costa Rica has really surged this year. So you'll notice that that stands out there with strong growth that I have penciled there at 48%. We've seen huge volume increases through August to Costa Rica. And then I also have strong growth to our top two markets in the region, Honduras, Guatemala, continued growth to El Salvador and Nicaragua. Where we see the one like really not on a record pace would be Panama. So exports up somewhat from last year, but below recent year levels. And again, for Panama, there's kind of a caveat there because this is based on export data. So it's when it's shipped to clear the quota at the beginning of the year. So this is kind of different. It's a lot different when you look at the import data compared to when the time the product is coming out as an import. So that one's a little different when we're comparing the export versus import data trends. But again, strong growth otherwise across the region at record volumes. So here's my last slide, just to summarize a little bit. So the situation on pork, we have a strong increase this year. It will be the second highest production year on record after the 2021 record. And we do expect to see modest production growth in 2025. USDA is forecasting 2%. I think, private analysts would be lower than that, but still expecting modest growth in 2025. And we do see pork exports continuing at record levels. And a big portion here is strong demand in Latin America. So that is one of the big contributing factors there. So we continue to see as we continue to ramp up this domestic production, and as we are exporting a larger share of our U.S. pork production, items for more items on exports here. So more opportunities. And so it's always worth checking with your suppliers on possibly adding new items or maybe items that were harder to get in the past, because we do expect to see this continued market of larger production and more of that going to export. On the beef side, U.S. fed beef production, as we talked through, is above year-ago levels, but that is going to decline in 2025 and again in 2026 as producers rebuild the herd. So they'll have to keep females on the ranch in order to rebuild the herd. That's going to limit the supplies that go to feedlots. But our production of prime and choice beef will continue to be relatively large. The decreases there will be more minimal than the overall beef decreases as we continue to see the heavier carcass weights and that focus on producing high quality beef. So we are at the point right now where we're monitoring any herd rebuilding. We'll have the cattle on feed report that comes out at the end of this month. We'll have details on the percentage of heifers that are on the feedlots, and that will be kind of one of our first indicators of if we're seeing that turn in herd rebuilding. So the time is now as producers are making decision at weaning time in the fall if we're going to see some more herd rebuilding, and we'll continue to monitor that as that is expected to gain more momentum with herd rebuilding in 2025. And so then we do expect that we can see those larger beef supplies come into the pipeline in 2027. And, beef exports, I talked a lot about the strength in the domestic market, but beef exports remain critical to the industry. Central America, as I mentioned, and I should have said more, is, a standout market for beef growth, setting records, even through pandemic challenges. And this is a market that continues to be prioritized. It is one of the few record growth markets this year as well. And so we continue to see the importance of exports to Central America for the U.S. beef industry. And so with that was my last slide. I know that I'm right up on time, but I'm happy to take any questions if anyone has them. And with that, thank you for your time.
Muchas gracias, Jessica, por toda esta información. Sabemos que nos va a ayudar mucho en unas proyecciones futuras. Si alguien tiene alguna pregunta, alguna duda, por favor, ya sea que pueda levantar su mano o hacerla por el chat. No, ninguna. Bueno, damos por finalizada entonces este seminario, esta charla. Muchísimas gracias, Jessica, por toda esta información. De plano que nos va a servir mucho para, como les comentaba, para hacer futuras proyecciones en lo que es la región, ¿verdad? Y muchísimas gracias a todos los que se conectaron. Estamos aquí a sus órdenes y pues pasen una feliz tarde. Gracias, Jessica.
Thank you.